Let me give you a different potential interpretation of the catalyst. So if you hover over where 2024 starts, that is when it became clear to the market that Ukraine's counteroffensive against Russia had been defeated. And in our view, that's when the market decided the war was lost. Now, a war can be lost and the combatant not yet be defeated. We call a war lost when it can no longer be won. And if the market decided that Russia had defeated NATO, i.e. the US, in a proxy war, that would be a catalyst for major change that we're seeing today, China standing up to the US in a way that would have been unthinkable 10 years ago, then this is telling you that that's when everything changed.
You're watching CapitalCosm. My name is Danny. My guest today is the green chicken himself. It's Doomberg. Doomberg, thank you so much for coming on the show, my friend.
Danny, always a pleasure. So fun to see you grow. And I know we always have great conversations. Looking forward to another one.
Yeah. And couldn't come at a better time, actually. We've got a lot of stuff to talk about, Doomberg. I know you've recently published a new piece. So if you want to talk about that or anything else that's topical on your mind right now, the floor is yours.
Sure. Yeah, we're publishing actually tomorrow. We're recording this on Wednesday today? I guess days kind of blur together.
Yeah, it's Wednesday, October 15th.
Yeah, we're publishing a piece tomorrow on China. The title is Gloves Off, and we think last week profoundly changes everything about geopolitics and the financial world. It was a profound week, not trying to be hyperbolic, but we think that China dropped what is tantamount to an economic nuclear weapon on the West. We believe that China has total escalation dominance in this trade war with the US. We believe that Trump will soon be seeking a face-saving way to de-escalate and then try to spin that as a negotiation victory. But make no mistake about it, what China did last week was decades in the planning. And we believe they would not have fired that cannon if they didn't think it was incredibly effective. Of course, what I'm talking about is China's shocking move to exert control over the rare earth market and the magnets produced from them in a way that mirrors the way the U.S. has tried to issue tariffs and sanctions and control the flow of semiconductors. And this really is a real game changer. Happy to take it in any direction that may have caught your ear.
Yeah. Let's go ahead and take it with what the market reacted to it. On Friday, the market puked at the news, and ever since then, it's been back up. Is this some sort of a dead cat bounce, or what here? What do you anticipate from the recent price action in the markets? We've got a number of charts we can look at here. I'll pull them up here shortly. So you've got the S&P right here. And the S&P is rallying again. It's up about 1% this month. 6 months ago, up 26%. This year, it's up 14%. And of course, the tool that I'm using, guys, as the sponsor of today's video, it is the forecaster.biz. We do have a special coupon code down below for you guys to use to get a special offer. It's CapitalCosm 10. It's in the description box down below. Be sure to click on the special link as well as enter in your coupon code in the description box down below. They got a ton of cool tools that we'll be showcasing in this video. So Doomberg, as you can see, the S&P is skyrocketing. You look at all the various components of the S&P, NVIDIA, from a ratio perspective, the market caps are from a ratio perspective. You're looking at a 51 PE ratio on NVIDIA, 37 on Microsoft, 37 on Apple, 26 on Google. All these PE ratios are, they're not really that cheap, but despite the news, we are seeing some upward momentum. What's your take on this?
Yeah, first of all, great looking tool. If you think about what happened on Friday, Trump shocked the markets with his very long post on Truth Social, which caused stocks to tank. I think it's peak to trough was 5% on that day. Yeah, you could see it right here on this chart.
Mm-hmm.
And then what we're seeing now, we believe, is just sort of the classic taco trade. The market is pricing in that Trump will have to, Trump always chickens out is what taco stands for. That's not really a dig on Trump. Our view of the taco trade is a little more subtle, which is that Trump, as a negotiator, always assumes he has escalation dominance in any negotiation. And there's a few instances where he just does not, one being militarily against Russia, unless he's willing to use nuclear weapons, and the other in the trade war with China, as China proved earlier this spring and is about to prove again with this latest action. So yes, Trump has escalation dominance against Western Europe, the UK, Japan, Korea. The common lineage between all of those countries is they have U.S. military bases on them. So of course the U.S. has escalation dominance in trade negotiations with Europe, but it has no such leverage against China. And in fact, as we have been warning about for years, China has been slowly but surely accumulating monopolistic control over critical supply chains, the absence of which will cause the Western economies to grind to a halt. China could close every automotive manufacturing assembly line in the Western world. It can stop ASML from making advanced lithography machines. And last week, it laid the framework for how they will go about doing that by insisting that anybody who even re-exports something with trace amounts of rare earths in it would need to apply for an export license from China. So for example, ASML uses many, many high-end rare earth magnets in its advanced lithography machines. And the only explanation for ASML stock price is the market is pricing in that China's going to win, and ASML will not lose access to. Pull up the 1 month chart on that, so we can look at what happened. See what happened. See what happened. See what happened on Friday. And so, in our view, Trump and Besant are talking a tough game right now, but the markets are telling a different story. And so, China is essentially punching back. If you read the Chinese propaganda and the propaganda of many countries in the global South, this is being applauded by the prior victims of U.S. sanctions and what the Chinese would call arrogant U.S. policy. China is usually not a country that can be bluffed. And we're going to find that out here in the weeks and months ahead. And this is the essence of our piece. It'll be controversial, of course. That's nothing against Trump. It's not a political statement. It's an objective analysis of the geopolitics as they are today. And it's just, when China has monopoly control over core elements that are critical for the entire economy to run, we're talking electronics, consumer goods, all manner of advanced technologies and simple technologies are now under the auspices of Chinese control. And this is the hill that they've basically declared they're willing to die on. It also tells us a few other things. We think it tells us that China must feel pretty confident in the development of its own semiconductor industry and its own lithography machines. They've been working very hard since Trump started the first trade war in his first term, and we think they're making far more progress than Western analysts believe. So really amazing story, historic last week, really historic. We think it's not an exaggeration to say it sort of marked the end of 50 years of Western financial system based on the U.S. dollar and U.S. treasuries and its dominance. China is standing up and saying no more, and we're willing to fight to the finish.
Interesting. Is there a way we can unwind this back, or are things set in motion that cannot be unset?
Well, the Chinese will negotiate with the U.S., but they will demand certain things in return that I don't think Trump and Besant and team are prepared to accept. A very similar situation to the war in Ukraine. There were discussions. Putin and Trump met. The Russians reiterated their stance. Ukraine similarly rejected Russia's demands, and Russia has, of course, rejected Ukraine's demands, isn't even really negotiating with Ukraine. And so Trump just sort of refuses to recognize the reality on the ground. And I fear it's going to be the same situation here. We'll see. One thing for sure, Trump pays very careful attention to the stock markets. And if stocks start going down because the trade war escalates, that's typically when agreements are made. Let's put it in the nicest way possible.
Yeah, you had these comments earlier today by President Trump saying that BRICS membership is falling down a cliff. Countries are leaving BRICS because of this tariff that he's slapped on to any members who join it. But I haven't seen any news of any like, the core members are still there as far as I know. Brazil, India, Russia, China, South Africa, Iran is still there. I believe Saudi is still filling out their form to join. Dubai, UAE is still there. So what is President Trump alluding to here?
I have no idea, Danny. Like, it's plainly untrue. So there's two possibilities. He's just saying it, knowing it's untrue. In which cases, Trump's been known to do that, a bit of a troll, right? Or he's saying it and he believes it, in which case he's getting terrible advice from somebody, because the opposite is happening. The tariff campaign is driving BRICS closer together and accelerating the need to develop alternative means for the settlement of imbalances in international trade outside of the US dollar Western-backed financial system. And the price of gold is telling you that that statement is just flat wrong in our view. Every day you wake up, it's up another percent. 4,200 this morning as we're recording this. Yeah, I mean, look at that chart. Historically, when the price of gold doubles in, let's say, 2 years, as measured in the reserve currency, that's generally not a good sign. That means financial systems are changing, or major wars are coming, or both. And so we own a lot of gold. I own a lot of gold. It's the one asset that unsettles me when it goes up too quickly. And that is an Icarus print chart if I've ever seen one.
Yeah, I mean, this literally looks like a hockey stick, literally. And if you look at some of these overbought, underbought sentiment indicators, and you look how red hot gold has been the last, the last month or so, since the end of August. It's been, white hot, moving its way upward. Does sentiment matter at this point in time, or is it because of the fact that the buyers are central banks that your usual orthodox analysis of things being overbought from a retail investment standpoint, it's not as important? Would you buy more gold at this level?
It's fascinating. I was just having this discussion with the editor of Doomberg, one of the co-founders, and I wouldn't add to my position here, but I wouldn't sell either. I'm happy to own what I own. Now, I should say we don't view gold as an investment. We view it as a savings vehicle. But within our savings portfolio, we'd like to have a certain balance of gold and collectibles and land and things like that. And gold is becoming an ever-increasing share of our savings portfolio because of its appreciation as measured in US dollars. It looks like it's overbought, but who owns it? It's not like it's a retail frenzy, right? I mean, it's wildly underowned compared to NVIDIA and other stocks. And so, I'm not a trader. Nobody should trade based on anything I say. I own a lot. I'm keeping it. If it goes down, it goes down. I don't plan to sell it. I plan to sort of leave it for my kids. So it's one of those assets for me. And if we are heading into the type of geopolitical chasm that we think we're heading into, then who knows? It could double from here.
Yeah, because you look at the gold chart, especially from a 10-year time frame or any time frame beyond that. I mean, this literally looks like a vertical line up.
Yeah, it's
like it's unprecedented. Like I don't think I've ever seen anything like this on a gold chart before.
It's unsettling. Yeah, it's unsettling. Yeah. And let's put it that, because it's not just a silver squeeze, right? Gold has meaning beyond the trading vehicle. It is a store of value. It is nobody's credit, so it's an asset that is truly neutral And with the sanctions campaign that the U.S. has uncorked, it has destroyed the neutrality of U.S. treasuries as neutral reserve assets. If you're a country that has ever been or might ever be in the crosshairs of the U.S. State Department or the U.S. Department of the Treasury, you have to ask yourself, are these really my assets? Russia has a couple $100 billion sitting in Euroclear right now of assets that they have title to that that is basically being stolen from them. So if you go back to that gold chart, I will point out an interesting thing. If you scroll over to like February 2022 there, at the start of the war, gold has basically doubled since the Russian invasion of Ukraine.
That is true, yeah.
And I asked my good friend Perplexity to tell me, the value uplift of the holdings that Russia had at the end of 2021, and it's basically offsetting what has been frozen. I think, plus 150, 200 billion in value just on the gold they owned back then. And so they've covered the hole created by the freezing of Russia's assets and the ongoing attempts at seizing them. And so the market is telling you something, that profound change is coming. And if Trump truly believes that BRICS is falling apart, then we have much bigger problems.
Yeah, because here's my thinking, Doomberg. Because you look at this chart, you notice that this recent rally in gold happened as a catalyst, at least that's what it appears to be, a catalyst of the Biden administration freezing Russia's assets and this sort of discrediting of the United States as a country governed by the rule of law. I mean, jurisdiction was a big selling point in placing your capital in the United States, because if you place your capital in the United States, you would have the guarantee that your capital would not be under the whims of men. It would be under the whims of the law. It would be under the governance of the law. However, that was thrown out the window shortly thereafter, February of 2022. And that's when you began seeing BRICS come back on the scene. BRICS had formed in the early 2010s. But
2009.
Yeah, 2009, actually. But they were never a prominent fixture on the news, or at least not in during 2022 and in that time period. But it was only after that invasion of Ukraine that BRICS came back into the fold in a big way. And that's when you started hearing this talk about a new settlement currency backed by gold. And that's really when this gold rally started. So if the catalyst is that, and nothing has changed since then, what's to stop the recent rally in gold from changing either?
Let me give you a different potential interpretation of the catalyst. So if you hover over where 2024 starts, that is when it became clear to the market that Ukraine's counteroffensive against Russia had been defeated. And in our view, that's when the market decided the war was lost. Now, a war can be lost and the combatant not yet be defeated. We call a war lost when it can no longer be won. And if the market decided that Russia had defeated NATO, i.e. the US, in a proxy war, that would be a catalyst for major change that we're seeing today, China standing up to the US in a way that would have been unthinkable 10 years ago, then this is telling you that that's when everything changed. The world's superpower, the holder of the global reserve asset, has been defeated militarily. Again, controversial statement. You'll get all kinds of pushback. Let's see in 5 years whether my statement is correct. And the market for gold took off because, if Russia had been defeated, maybe that cowers the rest of the world and they submit to the US dollar system and all of the rules-based international order and all that stuff. That would have been a death blow for BRICS. It would have really shocked China. But the fact that Russia has emerged stronger, China has emerged stronger, Russia is vastly outproducing NATO. We see these things like the head of NATO, Mark Rutte, was at a conference yesterday, I think it was, and he's saying like the European and American economy is 25 times bigger than Russia, and of course the NATO militaries could crush Russia if they wanted to, and their air force would dominate Russia. This is just utter gibberish. I mean, I don't know what planet he's living on, but that's less true than what Trump said about BRICS. And so if they don't believe these things to be true, it's disturbing that they're saying them. If they do believe them, it's even more disturbing. The market is telling us that the last 50 years of US deindustrialization, Nixon taking the US off the gold window, the US managing the dollar to be as good as gold for oil, all that went away in the global financial crisis. World War III started with the Crimea affair, and when Putin started dumping treasuries and buying gold, and when Shanghai, the Chinese opened up the Shanghai physical gold exchange. This was all overt moves, well flagged by their central bankers, to rid themselves of the dependency of the US dollar system so that they could trade with and amongst themselves and not be subject to the Eye of Sauron, which has been Hunt's great nickname for the US Department of the Treasury. And what we're seeing is militarily the combination of China, Russia, North Korea, and Iran is defeating NATO in Ukraine. It's not really a war over Ukraine. It's a proxy war led by the US against Russia, fought using NATO weapons and predominantly Ukrainian soldiers. And so, the market is reflecting this. I think that's what the price of gold is telling me when I look at that chart. Because if you look at the first 2 years, the issue was in doubt.
Yeah.
Right. The issue was no longer in doubt when the huge Ukrainian offensive of 2023 was defeated by Russia on the battlefield. Certainly, Ukraine made some gains, but now since then, it's been one-way traffic. Russia's fighting its traditional grinding war of attrition from east to west. Many analysts in the West erroneously measure the progress in the war in acres. Russia's objective is to demilitarize Ukraine and to destroy its army. And so you'll often see them leave pockets open for reinforcements to come in so that they can continue to sort of destroy them in what they call kill zones. Wars of attrition, and suddenly Ukraine cannot win a war of attrition against Russia. And we're seeing that play out right now.
Yeah, it's very interesting. And it's very interesting you make that point, Doomberg, because yes, you look at the chart here, February of 2022, things moved sideways for a couple of years. And it's like you said, sometime in early 2024, it was somewhat of an inflection point. That's when gold really started to move up. And, one thing I really like about, this tool is, you can look at projections based off of their own internal algorithm, utilizing past data and historical data to forecast out into the future what that algorithm would anticipate would be the next move in any given asset. In this case, we're looking at the gold forecast. Of course, it's called the forecaster, right? So you look at you've got a best case scenario, the bull scenario, the bear scenario, and the best case scenario down here. And what's also cool is that it'll tell you how much confidence it has in that forecast. In this case, the projection is weak, meaning the data, there really isn't much correlation to past historical events in this recent price move in gold, which is what we've been talking about. This really is an unprecedented move, at least relative to our lifetime. Just an FYI, the bull case scenario is that we launch up to 4,600 sometime in December, and then close out the year around $4,400 gold. And the bear case scenario is that we close out the year around $3,800 gold. But as you can see, it's a wide interval, and there's not much confidence in the projection. So it's very interesting times. I want to get to your take as well, since I think you were kind of wanting to move down this route. We're going to talk about oil here. Let's go ahead and pull up the oil chart. Oil has not been making a strong move, though, lately. Why is that? Oil is, isn't oil supposed to go up with geopolitical crisis, if nothing else? So why has it been relatively subdued? You can see the layout here. It's down 8% this month, 5% over 6 months, 19% this year. It's down 30% over 3 years. Now, granted, from a 5-year time frame, it's up 45%. But you look at this downtrend in oil. Shouldn't we anticipate? Is oil relatively underpriced here? And also, you can look at the seasonality too. The seasonality in oil today, as of October 15th, relative to the 5-year average in blue, relative to the 20-year average in blue, it's way underneath what it ought to be from a historical basis this time of year. So, what do you make of that?
Yeah, go back to the price chart if you don't mind. Look, for the past several years, we have been arguing that peak cheap oil is a myth. We wrote a piece with that title. We debated high-profile people who believe that peak oil is just around the corner. The reason oil is cheap is because there's too much of it, Danny. There's just an infinite supply of oil and gas underground. The technology to bring it to the surface is increasing in its sophistication at an exponential pace. Layered on top of that, China is building out coal to chemicals, and the US has an enormous natural gas advantage, which is then leading to engine switching. So China, I believe I saw a stat in Bloomberg, Javier Blas, great energy columnist for Bloomberg. He said that if all of the coal China uses to convert into chemicals like diesel and so on, if that were a standalone country, it would be the second largest consumer of coal in the world, behind only China. That's the scale with which China has been displacing its oil weakness with internal coal. It's not the ideal process, but it works and can be done. And if coal is cheap enough, it can be economical. And they're switching diesel trucks to LNG because natural gas is cheap. And they're switching gasoline demand into EVs in the cities at significant scale. And so, when you just combine how much oil there is in the world and the switchability into coal or natural gas, the fungibility of all the hydrocarbons, you look across the entire energy matrix and there's just too much of it. There's no other way to say it. There's a lot of oil. And by the way, if you price oil in gold, you can buy 70 ounces of oil with an ounce, 70 barrels of oil with an ounce of gold today. That's historic.
Right.
It used to be around 10 in the sort of 80s and 90s, between 10 and 20 is where it would circulate. And so there's just a lot of oil. By the way, we no longer hear from the peak cheap oil crowd. We won't hold our breath waiting for an apology from some of the particularly vulgar ones who had entire web pages stood up to mock our call that peak cheap oil was a myth and to question our analysis skills and our knowledge of how the energy markets work. It is what it is. We're in the arena. People can disagree, but I think we've gotten this call pretty darn well.
Yeah, what does that mean when the gold to oil ratio is that high? I mean, why would there be a disconnect right now? Do you see mean reversion coming into the future, if either by the gold price coming back down to meet at parity to the old mean, or vice versa with the oil price going back up? It doesn't sound like either case is bound to happen soon, based off of what I'm hearing here.
So our friend Luke Roman at Forest for the Trees writes a weekly newsletter called Tree Rings, which I've been reading for years. And his belief, and I tend to agree with it, is that oil for gold trade has been going on behind the scenes, and that is incredibly bullish for gold. And if that's true, the total market cap of gold needs to be much higher for it to effectively play its role as a neutral reserve asset. And so there's a thesis where that number will continue to rise. But we plot it because it's sort of real dollars, right? Real money, not real dollars. Like, and our view is the long-term real price of all commodities is lower because we're not running out of them, and we're forever getting better at bringing them up to the surface. And so, but if you don't want to plot oil and gold, just plot it using the Bloomberg inflation index, and I'll pull it up on my Bloomberg terminal as we're speaking. But the price of oil in like $1983, which is what I think they use, the spot price of oil today in those dollars is $18 a barrel. That's how cheap oil is in real terms using Bloomberg's inflation adjusted index. And by the way, the oil companies still make money. It's because they're really good at technology, right? So we don't like to own commodities, and we don't even really like to own companies that produce them. If you must feel the need to invest in the energy space, you want to find companies whose profit scales with volume, not price. So midstream, service providers, royalty companies. If you're paid $2 a barrel royalty, no matter what the price of oil, it's probably a much better business to be in than a price-taking commodity producer. And so, but that's our view of the markets. And again, if you ever hear somebody talking about peak oil or Hubbard's peak or Hubbard's curve or the Permian is going to roll over or shale is exhausted, you can fade all of that talk.
I see. Doesn't that sound like a tailwind for mining stocks then? If your input cost vis-a-vis the oil price is relatively subdued and the output price, what they've actually produced, gold, silver, etc., are going nowhere but up, doesn't that signify an expanding margin in the process? Are you bullish mining stocks at all? I know you said you're not, you prefer not to invest in commodities, but what about mining stocks in this case?
So if you separate gold from the other commodities, the long-term real price of all commodities is lower, and all things being equal, getting a break on your diesel bill is useful, but it's not as powerful a leverage stick as the price of your commodity. And so if the long-term real price of all commodities is lower, why would I want to invest in a nickel miner? Because the long-term real price of nickel is lower. As look, it might spike, there might be shortages, it might, there might be demand spikes and all that stuff. Silver is another exception because it's a byproduct, and so generally immune from sort of elasticity considerations. But the copper and the nickel and lithium and even cobalt, even though the market is kind of going through a bit of iterations right now because of what's going on in the Congo. Look, the long-term real price of all commodities is lower. Why would you want to own anything whose price is guaranteed to go down?
Gotcha. Yeah, you mentioned silver. Let's get your prognosis on silver here really quick. Silver currently sitting at an all-time high of $52.50 here, kind of making the same looking pattern that gold did. It's going parabolic, it seems. What's your take on the recent price action in silver?
So the person to follow on silver is our friend JJ at Market Vibes. I think it's jj745.substack.com. Great guest if you haven't had him on already. He's a 50-year trader in the pits, gold, silver, oil, and he's been chronicling this run up in silver for some time. He really knows the inner workings, and just read his latest Market Vibe piece this morning. Silver is in the middle of a squeeze, and there's literally a physical squeeze of bars being shipped from London to New York ahead of the COMEX settlement. And that's about as much as I can say and still sound intelligent on the subject. I don't own it. I don't trade it. JJ's been talking about it for months. He's been long silver since I think the mid-20s, and any readers of his that went along with him have seemed to have done pretty well. And so I would advise people to go check out his Substack for a trader's analysis of what he thinks is going on. By the way, if you don't sell into strength, when will you sell? As my good friend Tony Greer likes to say at TG Macro, the Morning Navigator. And so silver is not a monetary metal. It's going through a physical squeeze. And so all shortages eventually lead to gluts. And, and so I don't know how much longer this squeeze will happen. As he said to me via text earlier this week, it's a dangerous market right now.
A dangerous market in terms of what?
Silver, getting chopped up. You don't want to be shorted. You don't want to
be shorted. Okay.
But also, when do you take your profits? Like, it's a hard market to trade when things are going, if you have your stop losses too close and you get stopped out of a trade and then the bull run continues, it's a difficult market to trade. That's all.
Yeah. And to your point about gold, you look at the silver chart and you can see the inflection point again was the early beginnings of 2024. January of 2024 is when it looks like things really started to take off. Sure. Around here in February. So is there a connection there as well with some of the outcomes we've been seeing in Ukraine?
I mean, I suppose if your long-term view is that the U.S. is going to inflate its way to a rejuvenated manufacturing sector, then owning things like silver in U.S. dollar terms might be interesting. So sure, but I think gold is central bank buying mostly. Silver is actively traded. It's got a vibrant Twitter community. A vibrant community on Reddit. Wall Street Silver, that Twitter account was born out of that whole silver squeeze phenomenon. So it's just a different animal than gold, but the charts look exactly the same. So if we're reading too much into gold or not reading enough into silver, I suppose.
Gotcha. Well, Doomberg, it's been a fascinating talk as always. Anything else that you need to talk about that we didn't get into before we sign off here?
No, it's always great to talk to you, Danny. You can find all our work at Doomberg.com, and don't forget to check out our new project, Classics Read Aloud. Substack.com. The co-founder and editor of Doomberg has started her own passion project. It's a sister publication of Doomberg, operated by the same team. Wholly different content than what we produce on the Doomberg masthead, but the same quality, the same brand excellence. Classicsreadaloud.substack.com if you want to check that out. Danny, always great to talk to you. Looking forward to our next discussion, because Lord knows, every time I come on, it's not like there isn't anything interesting going on in the world.
No, not at all. Well, hey, Doomberg, thank you so much for your time, my friend. Guys, if you enjoyed this podcast, drop us a like and comment. Go Doomberg, go in the comment section if you agreed with what we had to talk about. And if you disagreed, feel free to leave a comment too. I do, in fact, read all the comments. So let me know what you think. Subscribe to the channel so you don't miss an episode. And again, this video was sponsored by the Forecaster tool at forecaster.biz. We do have a special coupon code, CapitalCosm 10. And be sure to click on the special link down below as well. So if you want to use the same tool that I use in this episode, that's where it is. It's in the description box as well as the pinned comment. So I appreciate your time, guys, and I will catch you later. Bye.